Don't put all your eggs in one basket. You must have heard this adage many times. But in the world of finance, it holds great importance. I'm repeating, don't put all your eggs in one basket. Do you know why? Because the world of finance is full of uncertainties. Many times I come across so many people who want to invest in their financial market, but they feel that because of uncertainty, they are not sure. They are not sure which financial assets to invest in, how much risk are they willing to take, how much should they invest in each financial asset. Today's topic, Efficient Portfolio Frontier, talks about financial markets, uncertainties in financial market, risk and return in financial market, and how to take decisions related to investment in financial assets. This topic is from our course MEC 110, Money, Financial Institutions and Markets, and the course is MA in Economics. The code is MAEC program. Before I start discussing about Efficient Portfolio Frontier and Portfolio, let me also tell you that exams of this course, MA Economics, are on annual mode. We have divided the curriculum into semester for ease of studying. But if you have taken admission in July cycle, you will give exams of both the semesters in June next year, that is after 1 year. You will have to submit your assignments related to these courses in March before giving exams in June. Coming back to our today's topic, Efficient Portfolio Frontier, which is often attributed to an economist, a financial economist named Markowitz, who wrote a paper in 1952. Now, before we come to discuss about what he said, what was his theory, and what is Efficient Portfolio Frontier, let us briefly discuss what is portfolio, what is portfolio management, how do you manage your portfolio, and what is the need for portfolio management. Today's session will give you insight on how to decide about investment in different financial assets. So as you may be aware of, portfolio is a collection of investments owned by an individual or entity. It includes various assets like stock, bond, mutual funds, etc. For example, if you have a portfolio, it means that wherever you have invested in, say you have invested 10% of your capital in shares, 10% in fixed deposits, 20% in mutual funds, 40% in something else, all this will comprise of a portfolio. Portfolio is, not a very static concept. You also have to remember. It's a very dynamic concept. So for example, this year I have invested more in shares. Maybe based on situation, I can change it. Maybe next year I may invest in mutual funds more. How will I decide that? Well, it will depend upon various factors. You keep on looking into market, you keep on looking into company's performance. Overall, whenever you are doing your investment, you have to remember that adage which I mentioned in the starting. Don't put all your eggs in one basket. Try to diversify your portfolio as far as possible. Traditionally, whenever people used to decide about investment, they used to compare risk and return of an individual security. For example, if I'm investing in a stock A, stock B, and stock C, people will look into risk and return of stock A, they will look into risk and return of stock B, and so on. However, in 1952, Markowitz said that you don't need to analyze individual securities or individual investment. You need to see your portfolio as a whole, and you need to reduce the variability of your portfolio as far as possible. Well, how far as possible? It will depend upon your individual investment goals, the money that you have, and the time period for which you want to invest in. We will come to that later. Let us briefly look into what is portfolio management. As I mentioned, that investment is not a very static concept. It's very dynamic. You have to keep on looking into what is happening in the market, how things are changing, how companies are deciding about their different policies, and then you have to change your investment accordingly. Now, what is your main goal? As you can see in the slide, to create a portfolio that mention your specific financial goals, risk tolerance, and time frame of investors. What do we mean by financial goals and risk preference? Well, some people, as you know, are risk averse and some are risk lovers. Greater risk usually means greater returns also. However, some people would like to take limited risk. Limited risk, again, is a very subjective concept. It will depend upon investor to investor. So portfolio management is a very unique approach which varies from person to person. What your goals are, how much risk are you willing to take, how much capital, how much time frame you want to invest in will decide your portfolio management. So it's a very unique concept and varies from individual to individual. Again, you can understand it with the help of an example. Say there are 4 investors. One is a risk lover, wants to invest in risky assets but want to earn profits also. That person knows that more risk may lead to more returns. So he may invest more in shares, stocks. On the other hand, there may be person 2 who's interested in more fixed returns, less risk. That person may invest more in fixed deposits, maybe mutual funds also that give you a assured return. Third person may be somewhere between risk lover and risk averse, maybe risk neutral. So they may invest something in stocks, something in fixed deposits to diversify. The fourth person may be even more risk lover, somewhere more towards loving risk, but not completely risk lover as the person 1. So he may invest little more in stocks, little less in fixed deposits. So I'm trying to tell you that project management and portfolio management depends upon individual to individual. Now, when you are managing your portfolio, there are some things, some stages that you will have to keep in mind. First stage of portfolio management is defining investor goals, constraints, and preferences. Like I mentioned, that each individual may have different goal and different constraints and different preferences also. So first of all, when you are managing your portfolio or somebody else's portfolio, you will have to identify these goals, constraints, and preferences. After that, the next step would be formulating and implementing suitable investment strategies. Suitable investment strategy, again, is a subjective concept and it will depend upon how well you have defined your goals, constraints, and portfolio. Third step in this line is selecting asset classes and securities based on risk return. Going back to that example, risk return vary from person to person and risk and return are related to each other. How do you calculate risk? How do you calculate return? We will talk about it in later slides. But this is one thing that you will have to keep in mind. Now, as I mentioned, that it is a dynamic approach. You will have to keep on monitoring and assessing what your portfolio is giving. Is it still aligning with your, excuse me, it is still aligning with your goals, and you will also have to evaluate performance of your portfolio regularly. Once you evaluate your performance and you see that it is deviating from your goals, you will have to again change your investment. So for example, the times when market becomes extremely uncertain, you can invest in more safer assets. You might have observed that due to a lot of geopolitical uncertainties these days, people are investing more in gold, maybe for stable returns. People are not investing in risky assets. The reason is that it is not aligning with their goals. And the last step is analyze results and rebalance whenever necessary. it may be yearly, it may be monthly, it may be quarterly, and so on. Well, it will depend upon the balance which is there in your portfolio. So portfolio management is extremely important, and to keep on track of it is also extremely important, because otherwise there are chances of losses and risk. And we have seen that people have incurred a lot of losses in stock market, in financial markets, only because they are not keeping themselves up to date. Now, what are the benefits of portfolio management? Like I was telling you, first important benefit of portfolio management is risk measurement. You have to consistently measure your risk. You have to evaluate your risk and act accordingly. Next benefit is that you can establish coordination, correlation, and diversification. What do we mean by diversification? Diversification simply means that not keeping your investments in one asset class, and also reducing the correlation between different securities. Often we have seen that there are various securities, the returns of each are correlated. How? Giving you an example, say you have invested in stock A and stock B. They belong to same industry, say automobile industry. Now, because of some uncertainties, because of EV vehicles more in demand, say share of stock A decreases. Then since stock B is also in automobile industry, it will also decrease. So you can say that the correlation between stock A, stock B is very high. Majorly because they belong to the same industry. Sometimes they are also related in a parent company relationship. Say stock A belongs to a company which is a parent company of stock B. In that sense also, in that case also, correlation between stock A and stock B is very high. In financial market, when we talk about diversification, we say that the correlation between different securities should be minimum. Usually we try to keep it less than 1. And in fact, that was one of the major contributions of Markowitz in 1952. Because by then we used to see only individual securities. But Markowitz said that it's okay if the risk is high in a particular security. That will always happen, because higher the risk, higher the return. But instead of looking at one asset, you have to look at your portfolio and try to minimize its variability. Again, I'm using this word again and again, variability. What do we mean by variability? Variability means difference between actual returns and expected returns. We will see the formula later, but you must understand that, see, there is some expectation from each share, from each stock. How is it varying? How the actual results are varying from the expected results give us the variability. When we are talking about risk return, we look into variability as an indicator, and we try to minimize the variability. Coming back to the benefits, it is also very important for, strategic planning and guidance. Whenever you are managing your project, whenever you're managing your portfolio, you not only have to look into your short-term returns, but also long-term returns. So, portfolio management is extremely important for long-term planning also. Now, portfolio management not only helps in managing your own investments, it is very useful in managing investments of others. And if you're doing so, it will help you in maintaining transparent and classified, clear portfolio management. Now, when you look into portfolio management or your portfolio carefully, you will also find out a lot of improvement areas. As you can see in the slide, this will help in highlighting weak spots also. Portfolio management will also help you in identifying profitable opportunities and switch on the assets, switch on the investments wherever it is needed. Like I said, that the core idea is don't put all your eggs in one basket, and diversification is something which is very important in minimizing unsystematic risk. You need to have smart combinations of assets so that you can reduce total portfolio risk. Ultimately, what is our goal? Our goal is better results with same or less risk. Okay, as we know that two important things when we talk about investment are risk and return. Higher the return, higher the risk. You have to decide about how much risk are you willing to take to get how much returns. Now, when we talk about risk, usually there are two categories of risk: diversifiable risk and undiversifiable risk. And the total risk is the combination of diversifiable risk and undiversifiable risk. Let me explain this with the help of example. Diversifiable risk is also called unsystematic risk. So firm-specific risk, say there are some strikes, some frauds, some management changes, or maybe company is not performing well due to firm-specific reasons. Nothing industry-specific, nothing market-specific. This is called diversifiable or unsystematic risk. When we diversify our assets, diversification of our portfolio help to reduce this category of risk, unsystematic risk. Because when you invest in different asset classes, you are able to avoid firm-specific risk, chances of loss due to problems at firm level. Now, undiversifiable risk relates to economy as a whole. It relates to market. Say there are some policy changes, there are some changes in geopolitical situations, say there is pandemic, there is inflation. These are called systematic risk and they can't be diversifiable. Why? Because they affect all the assets equally. Okay, so it is a market-wide risk. When we do diversification, when we do portfolio management, we have to try to reduce our unsystematic risk, but we cannot reduce systematic risk. Now, how do we calculate return? What is return? Expected return is something that you expect to get from an asset. It is usually calculated as average return weighted by the probabilities. What is the probability of getting that return? So, for example, if I'm investing in, say, share A, there is 0.4 probability that I will get 50% returns on that. So, based on expected return multiplied by probability, you can get the total expected return of an investment. Similarly, if I have to calculate for a portfolio, as you know that portfolio is a combination of different assets, portfolio can be valued as follows. As you can see on the slide, it is sigma Ni into Pi. Each investment multiplied by the probability of that particular investment gives us portfolio value. And weight of each investment can be calculated by sigma Ni Pi divided by V. What do I mean by weight of each investment? Well, how much each investment will hold in my portfolio. Say if I've invested in shares 20%. So shares, the weight of shares will be 20%. Now, when I'm calculating this valuation and the probability, I'm looking into various factors. For example, usually they are firm specific, like say price equity ratio, how much return I'm getting, how is market faring, what are the geopolitical situations, what are the risks involved with the firm, what are the market specific risks. All these factors play a very important role when I'm calculating expected returns and when I'm calculating portfolio variation. Now, as I mentioned, that when you are measuring risk, you usually look into variability of a portfolio, variability of an asset. So portfolio variance, as you can see in the slide, can be calculated as this. Now, in this formula, the third figure represents covariance. So, portfolio valuation, the return, not only depends upon how much return you are getting from each asset, how much is the variance of each asset, but their common variances also. Like I gave you example earlier, that sometimes assets are correlated to each other. There is high correlation. Whenever there is high correlation and the value is greater than 1, it means that your portfolio is not diversified enough. So for portfolio to be diversified, you will have to reduce the covariance. You have to see your covariance between different assets is minimum. And it can be done in various ways. In fact, there are a lot of softwares which are into identifying variability, variances, covariances of different assets. So usually, whenever investment in stock market is done, these factors are considered. Ultimately, the key word is diversification. Now, as I give you example, when I started off, I told you that Markowitz gave the concept of portfolio management, efficient portfolio frontier. It was his contribution that helped investors in maximizing return. And I'm repeating myself that Markowitz said that you should not focus on individual securities, but you should also focus on your variability of a portfolio. He was the one who introduced the concept of correlation among securities and how important is to see securities in relation to each other in order to truly diversify. So, Markowitz basically gave the concept of risk-return combinations. It talked about that ultimately we have to see that we are able to minimize the risk for a given return. Again, the steps of portfolio management will remain same. First, you will have to identify what your goals are, and then accordingly you have to invest. He also gave the concept of something called efficient portfolio frontier. As you can see in the slide, there is a curve which is called efficient portfolio frontier. There are 3 points on it, A, B and C. And there is also one portfolio C, which is under the curve. Anything which is under the curve, that portfolio is inefficient. So to make efficient portfolio frontier, what he suggested was identify different portfolios. Okay, identify different combinations of assets that you can invest in. Once you have identified different portfolios, say portfolio A, portfolio B, portfolio C, then calculate the variability of it and choose the portfolio with the least variability. Based on that, he plotted this curve, efficient portfolio frontier. Like I was telling you, any portfolio which is under the curve is inefficient portfolio. It means that it is not giving you results as you desired. It's not matching your objectives. So you can avoid this particular portfolio. Anything which is above this efficient portfolio frontier is unattainable, which means that we don't have enough funds and that's way above our goal. So we are not focusing on that also. A, B, C portfolios on the efficient portfolio frontier are the ones that we are going to consider. Out of these, it will depend upon how much risk are we willing to take and how much return we want from a portfolio. So say point A. Point A means low risk, low return. Point C will mean higher risk, higher return. And point D is somewhere in between. So usually people who want to diversify and who want to keep a balance of everything, they choose portfolio B. And again, all that is possible when you are able to identify returns, when you are able to identify variance, variability, and when you are able to identify which portfolio meets your specific needs of variability and return. Well, let's take a very quick example from your personal finance. Say you want to invest 40% in mutual funds, 30% in fixed deposit, which can be considered to be low risk, 30% in equity. That will be, kind of a efficient portfolio frontier. That's just an example. It is very general, but like I mentioned, which portfolio works best for you? Well, it depends upon your particular objectives, your particular needs, and the market situation. But the highlight of today's topic is that you must identify the risk and return in more scientific way. Just unlike, normally people, what they do is they follow others, which should not be the case. Also, one more takeaway from this topic, I can say, is that you should avoid extreme cases. You should not be extremely risk-taking. You should not be extremely less risk-taking. Somewhere down the line, maintaining balance is going to help you. So, learners, in today's session, we talked about a very important concept from our course MEC 110. And there are a lot of takeaways in personal life also, how to maintain balance, how to maintain portfolio. I'm sure you have benefited from this session, and we will bring more sessions on relevant topics for you in future. Thank you.